Okay, for sale of goods with trade discount, let's look at 14 December. Okay, they sold goods to Jane on credit. This price of $8,000, less 25% of trade discount. This goods cost $2,500. Meaning to say, okay, there is a trade discount, but this trade discount, okay, will not be captured in your accounts. Okay, so if there's a 25% of trade discount, the remaining balance that we need to pay, okay, we need to receive from Jane is actually 75% of $8,000. Okay, so it's $6,000. So Jane now actually we own a promise from Jane that she's going to pay us back $6,000. So it's debit trade receivable Jane $6,000. This $6,000 will come in as a revenue as an income and a sales revenue to our business. So it's a credit sales revenue 6,000. Now after we have tackled the part about the revenue, we have to tackle the part about the costs. Okay, so it's debit cost of sales 2,500, and because these goods actually leave our business into Jane's business, okay, so it will be credit inventory 2,500. Okay, if we were to actually open up the accounts or use the existing accounts, if you have watched the previous video, okay, there is actually a trade receivables Jane account already. So the highlighted one will tell you what is for this transaction. Okay, so on 14th of December, okay, the Jane actually bought even more goods from us. Okay, so it's she owes us more money. Okay, so we have more promise from Jane to pay more, so plus 6,000. Okay, 2,000 debit, you plus another 6,000 will give you 8,000 debit, and the opposite for this double entry would be sales revenue. Okay, and you must remember to write the working. Now we go on to our sales revenue account. Okay, we earned more sales revenue plus 6,000. Okay, so 2,000 credit, you plus another 6,000 will give you 8,000 credit. Okay, and your particulars will then be the opposite of this double entry, which is your trade receivable Jane. Remembering our working as well. Now we move on to cost of sales. Okay, it increases, so plus 2,500. Okay, will give you actually, okay, there's an existing balance of 750 debit. You add another 2,500 will give you 5,250 debit. Okay, so that would be, okay, the opposite of this cost of sales account for this transaction. This double entry will then be inventory. Okay, moving on. Okay, we also still have a inventory account. Okay, this existing inventory account, now we look at the 14th of December. Okay, it decreases by 2,500. Okay, because it has left our business. Okay, so we actually had an existing balance of 2,850 debit. You minus away 2,500, meaning to say we only have 350 debit balance for our inventory. The opposite of inventory in that double entry is cost of sales. That explains the particular.